Over the past year, Meta is up by more than 70%, which has obviously outperformed the market. Now, what is interesting is that from the start of 2023, when the company was trading at around $100 a share, it skyrocketed by more than 600%, by almost 700% actually. And the main reason for this is the increase in advertising costs. As someone who has advertised on Meta before, the advertising costs weren't as expensive before 2023, but after 2023 they have skyrocketed. And what this did for Meta is that it increased their profit margin tremendously. So if we jump to my stock valuation spreadsheets, to pillar 6 specifically, you can see that in 2023 the profit margin was sitting at 19.90%, and it increased by 9% into 2024, and currently it is sitting at 35.55%. That's a huge increase from 2023. And not only did Meta's 5-year profit margin increase, but their return on invested capital increased as well. In 2022, it was sitting at 14.41%, and currently it is sitting at 20.66%. So the increase of advertising costs is playing into Meta's favors extraordinarily well. Now, jumping to the stock screener, I have already plugged in Meta's ticker, or Meta, and all the metrics have shown up automatically. And by the way, if you want to download these spreadsheets for your own personal use, you can do so at the link in the description. It's a great tool for beginner and advanced investors. Now, first, let's have a look at their dividends. Their dividend yield is currently sitting very low at only 0.30%, but that is because they started paying out the dividend only in 2024. And since then, they actually haven't raised it at all, I don't think. Indeed, they haven't raised their dividend at all since they started paying it out. Now, one thing I do like about their company is their low debt. If you have a look at their market cap and compare it to the enterprise value, the difference between these two is essentially debt. So you can easily tell that they don't have much debt at all. Now, jumping to the 9-pillar analysis, they get a rating of 6 out of 8 with 2 pillars currently sitting in the red, and that is the 5-year P ratio and the 5-year price to free cash flow. And these 2 pillars essentially tell us that investors have been valuing Meta at a premium, willing to pay more for the company's earnings and for their free cash flow than they would be willing to pay for any other company. And this could be explained by if they have high revenue and high free cash flow and high net income growth, which they do. Their revenue has been growing at a rate of 17.83% over the past 5 years. If I have a closer look at Pillar 3, you can see that indeed it has grown by a lot. I mean, from 70.6 billion in 2020 to 134 billion in 2024. That is some extreme growth. And that is actually the same case with the net income, which has been sitting at almost 40 billion in 2024, and with the free cash flow, which is actually sitting higher than the net income at 43.8 billion. And for those of you who have watched the channel before, you know that I love when the free cash flow is higher than the net income, as the free cash flow is essentially the blood of the company. It is used for everything, for share buybacks, paying down debt, paying out the dividend, for acquisitions, etc. Unlike the net income, which is essentially just a measuring metric. So I'm in love with the fact that Meta has higher free cash flow than their net income. Though something I do not like that much is if I jump to pillar 1, that is the 5-year P ratio, you can see that for most of the past 5 years, it was sitting below 26. In 2023, it was actually sitting at 19.71, but in 2024, it jumped to 29.5, and currently it is sitting at 31.81. So Meta, even though they have been growing their net income, revenue, etc., the price investors are paying for the company has outpaced their growth rate. So currently investors are paying much more for the company than what they would be willing to pay for it over the past 5 years, and they are paying more for it than what they would be paying for an average stock. Now, Meta is a premium company, but I personally am not sure if I would be willing to pay this much of a premium. And this is actually the same case with the price to free cash flow, which currently is sitting at 40.43. As you can see, that is almost twice as high as it has been over the past 5 years. So I personally wouldn't be willing to pay such a high premium for Meta. And with full disclosure, I do not own Meta in my portfolio. But I mean, if their stock price drops, I really love companies that have high and consecutive financial growth, so I will certainly keep the company on my watch list. But now let me show you 2 more things I really like about Meta. The first thing is that over the past 5 years, they have been decreasing their shares outstanding at quite a high rate of 1.80% yearly. And what this does is that it increases the value of your investment in the long term. If you imagine that the company has 10 shares outstanding, you own one of the shares, you own 1/10 of the company. When the company buys back 5 shares, you now own 1/5 of the company, 1/5 of the shares outstanding. So you own a higher percentage and your shares are valued at a higher price. So your investment is growing at a compounding rate. And now let's also have a look at their debt levels. You can see that their long-term liabilities, which is something else than debt of the company, their long-term liabilities over the 5-year free cash flow negative dividends is indeed sitting very low at only 0.4. Now, if I jump to pillar 9, that is the long-term liabilities over the 5-year free cash flow, you can see that they have almost $60 billion in long-term liabilities. And you can say to yourself, well, that doesn't seem low, but that is very low compared to the free cash flow they are generating. I mean, in 2024, they generated almost 44 billion in free cash flow. So within 2 years, they can easily pay off all their long-term liabilities. So this tells me that if Meta was to start struggling, they would still have enough free cash flow to pay off all their long-term liabilities, so they wouldn't get into much trouble. Okay, so now that we have gone through the 9-pillar analysis and the company is looking quite well, let's calculate its intrinsic value and figure out if it's a buy at its current trading price. So jumping to the Graham's formula revised, we have to plug in the 5-year earnings growth estimate. Now I will plug in the high earnings per share growth at 14%, the medium at 12%, and the low, say, at 9%. And when I combine that with the analyst predictions, we will get a 5-year earnings growth estimate of 12.26% yearly into the next 5 years. And when I combine that with all the other values and plug it into the Graham's formula, we will get an intrinsic value of $323.53, which is more than 100% lower than the current trading price. Now, if I was to plug in higher growth estimates, say 30%, 25%, and 10%, let's go with that, the intrinsic value would still come out at $419, which is still 61% overvalued compared to the current trading price. But let's jump to the second valuation model, which is the discounted cash flow model. We will plug in the free cash flow over the past 5 years and calculate the average growth rate at 40%. Now, as we are predicting into the future, we are predicting into the next 8 years plus, into the long term, I will predict the high future free cash flow growth at 14, medium at 11, and low at 7. And this will give me a future growth rate of 10.7%. And with a discount rate of 9.7%, essentially the minimum rate of return I would like from an investment into Meta, I will get an intrinsic value of $560.40, which again is lower than the current trading price. Now, I also want to compare Meta to two of its competitors, Google and Microsoft. And when we take these companies' PE ratios, you can see that Google's PE ratio is lower than Meta's and Microsoft's is higher than Meta's. So when we average them out, we will get something in between, and when we multiply this by the earnings per share of Meta, we will get an intrinsic value of $668.36, which is only a little lower than the current trading price. Now, normally we would go through the dividend discount model, but as Meta didn't raise their dividends at all yet, we will skip this one and arrive straight to the ultimate valuation, where when we average out the 3 valuation models, we will get an intrinsic value of $549.28, which is 18.5% lower than the current trading price, and with a margin of safety of 10%, we would get an acceptable buy price at $494.35. And with that, I hope that you enjoyed the video. I hope that you find it helpful. Remember that if you want to download the spreadsheets, you can do so at the link in the description. And with that, make sure to leave a like and subscribe, as it really helps me out.